Hi, Matt McAleer, President, Director of Private Wealth at Cumberland Advisors, with John Mousseau here on October 6th, just after the close. Plenty of volatility has ratcheted up in the equity market. In terms of the VIX, little back off today. What I wanted to take a peek at, John, before we get over to the main event, which has been fixed income and continues to be, I wanted to take a look at a chart because I got phone calls today and people even buzzing around in the office saying, what turned this market around equity-wise, right? Down heavy off the print this morning in the futures market, carried through for the first half hour or so. What turned it around? And this chart gives you an idea of how powerful positioning is. We talk about it all the time. It's not the news, it's how capital is positioned going into the news.
Right.
And this is a market distribution table that I've shared with you many times before. When we get skewed to the far left, again, this is a 10-week distribution table. When we get skewed to the far left, that represents securities indices being very oversold. When we look at that, we're oversold across multiple assets.
Right.
Look at TLT, the ETF that represents the long treasuries.
It's had a hard few weeks.
AGG, the AG, which is a broad benchmark ETF we like to use. Those are on the fixed income side. But look at RSP, the equal weighted S&P 500. Right. So growth. Look at value, VOOV, the Vanguard value. Take a look a little further down, you see gold. Everything had sold off.
Right.
Really the only thing that was showing any kind of bid, look at the far right, the dollar.
Right.
And you know what's funny? We've talked about the fact that if the dollar was going to stay strong, the markets were going to have a difficult time advancing. And it has stayed strong. We're going to look and see if this overbought condition on the dollar can start to back off and give a little life, give a little breath to the equity markets. But as we spoke about last week, the equity markets, the commodity markets, even the currency markets, especially the dollar, are all contained by the action in the bond market. So talk to us a little bit, John, about some of that spike higher in rates, how we're treating it, what your thoughts are.
Sure. Today we got a surprise on the jobs number. It came in at 336,000. It's not often the market misses its estimates by this much because the market was expecting about 170,000. So it was a real head turner from that standpoint. Buried in there, from the bond market standpoint, right? Good news is bad news. And initially it was really bad news because the bonds were selling off, almost 2 points. By the end of the day, yields had come back down a little bit. So when you look for the week, 5-year Treasury is up about 15 basis points to about a 475. 10-year Treasury was up about 21 or so, up to about almost a 480. So again, some pretty good backoffs this week. In the beginning of the week, a lot of it was continuing fear of the Fed. I guess off today, they might think we're going to get at least one more rate increase this year. But it's interesting when you boil below the headlines, what was the good message that came out of that? Well, wage growth was slowing. And that is something the Fed has to be very pleased about seeing. The market should be pleased about seeing wage growth slowing because that has been the key point of the Fed. And, in the equity markets, good news became bad news, became good news, right? So what we think more is if you look over on the tax-free side, yields climbed higher this week. Not as much as treasuries because there was enough damage done last week in the muni market. But you're at the point where you're seeing longer tax-free bond yields at 5%. The deals get priced. They are clobbered with orders and oversubscribed many times. So there's plenty of demand out there for these higher yields on the tax-free side.
And to make that point, Moose, going back a year now, October of last year, that 5 was your attractive line in the sand. You wanted to be buying all the 5s you could of high quality.
And that was true, and that was last November. And think about last November, you were able to buy 5% tax-free yield. Now you can buy a long 5% tax-free yield. Back then, the 10-year Treasury was a 425. Now it's, call it a 475 to 480, 50 basis points higher. The real key back then, trailing inflation was about over 7.5, 7.7.
Right.
Now it's 3.7. Will be updated next week with the CPI and the PPI. So the fact that you can buy these yields at the backdrop of lower inflation, we think is an incredibly cheap buy, and we're adding accordingly.
And not to simplify things, but I think sometimes on the fixed income side, it's easy to get caught up in the inflation versus rates versus what the Fed's going to do. The fact of the matter is, in a tax-free muni account within our strategy, we've seen current yield jump over the last 24 months from about a 1.8% current yield to close to a 4.
Oh yeah, probably over 4.
Over 4.
Yeah.
Now what we have to do in speaking to clients and speaking to people that are in fixed income is boil it down to the fact if you're at a 4, 4.5, multiply that out over 4 or 5 years. You're talking about 20% return tax-free, and if inflation keeps dripping down, let's say it starts to run at 3, forget 2, forget 2.5, starts to run at 3. You're talking about a current yield in your tax-free bond portfolio of 4.25.
Right.
Taxable equivalent of that, 6.5, 7, versus a 3 run rate in inflation. 2x inflation out of your fixed income is golden.
That is a good buffer.
That's a good buffer. So we've gone on a little long here, but I thought we'd get into some of the weeds in fixed income. Let's see if the equity market, as oversold as it was, can keep its feet under it next week.
And we'll know also on inflation with CPI and PPI next week.
Busy week.
Yep.
Enjoy the weekend. We'll see you next Friday.